He's practicing into indirect tax litigation and advisory under Messrs. B.L. Subramania and Company. He's currently also the IDT committee chairman at Karnataka State Chartered Accountants Association. And he has also authored a book on time and value supply and FAQ based rendition on the subject, which has been published by FKCCI Karnataka Trade Body. He has been handling indirect tax litigation and has been a regular speaker on the subject. And we are happy to have you, B.L. Subramanian, today on this subject. And our
Arvind, your voice is. Yeah. Arvind, you have lost your voice actually. Okay, so
today's
back.
I could just come back.
Yeah.
Our second speaker for today's session is Gurjit Das Bullarji, and what I can say about him, that his command over the subject is such that when he writes so precisely on any subject, there is no room left for anything else to be spoken on the subject. And he is into practice for the last 23 years on direct and indirect tax matters. He has been handling the matters relating to automobile components manufacturing sector from 1989 to 2004. He is a faculty on ICI, and he has been representing training team to GSTN and training to GST officials, both at NASIN and at the state level. Welcome, Gurjit Singh Bullarji, and I believe that today's session would be an eye-opener and would be deliberating on each of the issues which were arising in the subject of ISD and cross-charge. Handing over the session back to the host today, Arupji.
Thank you, Arvind. Thank you so much. So I think the wonderful speakers that we have from both in Delhi and Bangalore. So I would request Subbuji, as we call him fondly, to take over the session from here. Then after Subbuji, I think Gurjit sir will also be there, and then they'll have a collab discussion on the question and answers that we have received from the group. So over to you.
Thank you very much. The team of ICI GST faculty
your voice
taken up this.
Subramanian, your voice.
Hello. Voice is stable. Hello.
It's a bit low actually.
It's a bit low. Okay. Hello. Is it now better?
Yeah, now it's better.
Yeah. So I would like to thank for this opportunity to the entire faculty team, in specific all those Arpit sir, Arup sir, Venu sir, Uni sir, and all those who have taken up this initiative to help us connect regularly and discuss on these aspects. So without taking any more time, I would like to just share my screen so that we can get into the topic. Is the screen visible, sir?
Yes. You can only change it to PPT mode. That's it.
Yeah. So just to give the agenda, it is briefly the sources of how the ISD and cross charge is in place, what the circular says, listed down a few issues that I could see in terms of the circular, and the questions which were shared in advance to us so that we could answer those. So this is the overall agenda which we would try to approach. So number one is on the definition of ISD. We are all clear with this. So this is basically an office which is receiving invoices towards receipt of input services, and it issues the prescribed document for the purpose of distribution of credit. and it does this distribution of credit to the supplier of taxable goods or services or both having same PAN as that of the said office. So this is something which we are already aware of. I've just brought out this manner of distribution and the relevant sections so that it will be easier for us to refer back in case if we have to in the course of discussion, if we have to refer any of these provisions, it will be easier for us to actually look at it. So on the cross charge 7.1c, where the supply includes the activity specified in schedule 1 made or agreed to be made without a consideration. Supply of, so when we go to this particular provision, supply of goods or services or both between related persons, schedule 1, or between the distinct persons as specified in section 25 when made in the course or furtherance of business. This is the entry. And 25.4 and 25 says many registrations in the same state, separate registrations in the different state will be treated as a distinct person. Now, what the circular says, as we have already gone through circular 199, circular basically refers to types of or two categories of services, if I have to say. One is the category of services which are procured by the head office from the third parties and distributable or attributable to the branch office. That is one section of it. The second section of it is the internally generated services. The new terminology which they have used is the internally generated services, where they try to give few examples. First is the services from third party. In simple terms, it only says that the head office has two options. One is to distribute, head office as ISD, registered as ISD, can distribute the ITC to the branch office. The second thing or an option which they give is it is not mandatory for HO to obtain ISD, and in which case they can raise the invoice from the head office to branch office if the services in question which are received from the third party are relatable to the or attributable or allocable to the branch office. This is what it says when it comes to the services from third party. So when it comes to internally generated services, it has two bifurcations. Number one is where there is full input tax credit available at branch office, the first situation. Another situation is where full input tax credit is not available to the branch office. So when the full input tax credit is available to the branch office, they refer to second proviso to rule 28 and say the value that you would have declared in the invoice will be considered as the open market value, because the purpose and intent of getting the second proviso to rule 28, as we understand from the placing of the section and how it has been indicated, it is to obviate the need of litigation or the interpretation when it comes to the value of supply inter se between the branch and head office. But one more additional benefit, if I have to say, given by the circular is that in case if it is not declared till now, the head office has not declared these transactions or has not raised, the exact wordings used is if they have not raised the invoice under section 31, then the head office, then the value will be deemed to be declared as nil by the head office to the branch office. This is what the circular says in terms of the relaxation, where they say it will be considered as nil. So there is no per se an issue. And when it comes to a case where the full input tax credit is not available to the branch office, the provision says that so once, as we know, once the input tax credit full ITC is not available to the branch office, the second provision to rule 28 would not apply, which would make it a case where you have to follow the regular provision of valuation as per rule 28 in that order. So once we go to the valuation provisions, it says the open market value. But however, the considering the very nature of the internally generated services which they try to refer, like the admin cost or the HR cost or the examples which are generally there. So these kind of services which are there, it is considering the issue when it comes to the valuation and to determine what exactly is the value. Maybe the last resort is the cost-based valuation which we may have to go, and the circular has also referred the cost-based valuation. But again, one more benefit, if I have to say, or the relaxation, if I have to say, is given is the salary cost which is there of the head office in managing the entire affairs of the company is not mandatorily required to be added in computing the value of service by the head office to branch office. So if you see this circular in entirety, where it has addressed two aspects of it, the two nature of services, one the services procured from third party and the second one is the internally generated services. So apart from what the provision already said, rule 28 proviso, what the provision already said, in terms of relaxation or as a benefit, if I have to say, there are 2 to 3 aspects. Number one is in relation to declaration. If there is no invoice at all raised in case of internally generated services from the head office to branch, it will be deemed to have been declared as nil. This is one thing. And the second thing is about the obviation. There's no need to add the salary cost while we determine the value of service from the head office to branch in cases where the input tax credit is not available. This is the plain provision as it is there in the circular. But there are a few aspects which are to be considered when it comes to the circular. The first of the aspect, once you see this, they refer to the word for which the full input tax credit is available to the concerned branch office. So what is this full input tax credit available to the branch office? We have discussed a little on this before in the context of few other contexts in the GST faculty group. However, I've just got these two situations and request the thoughts of the members as to what they feel about this being a case where full input tax credit is available or full input tax credit is not available. Scenario one, entity is into the petrol received invoice from head office towards certain marketing expenses attributable to the operations of branch office, lubricants. So what do you feel is the full input tax credit available to the concerned branch office so that you can take the benefit of the circular, or you have to get into the cost based calculation excluding the salary as given in the circular? What are your views? Any of us? Does this mean full input tax credit is available? Any thoughts?
Can we take reference to GKB Opticians AAR where they looked into full ITC?
So full ITC as in, do you feel based on the reading of AAR, do you feel it would be possible for you to consider even in this situation that full ITC is available?
I would venture to say yes.
Okay. So determination of ITC, at what point of time do you feel, sir, that it is available or not? Is it at the time of availing the credit, or what exactly is the point of time you see that the full ITC is available for a particular inward supply? So by the very nature, this marketing expenses are there for the entity as a whole, and a portion of it is distributed to the branch office is what they say. And it is well settled that they have two revenue streams. That is the very business, petrol and lubricants. Do you still feel that full ITC is eligible to the concerned branch office? Scenario one.
We have to see what is the nature of the marketing expenses.
The marketing expenses is for the entity as a whole, like both the branches put together, certain website related designing, or it could be something which has a bearing on both the branches, head office and branch operations, which will result in overall benefit to the business, in the sense the business.
Revenue will take a position that full ITC may not be available.
Full ITC may not be available. Okay. Keeping that scenario as is, let us go to scenario two. The entity is into business consulting services. Branch office has received invoice from the head office towards certain marketing expenses attributable to the operations of branch office for each of the 12 months. So even here, it is a business consulting firm which has branch office in one state and head office in the other state. The branch office has received the invoice from the head office towards the marketing spend, and there is an attributable portion even to the branch office, and this marketing spend is being billed from the head office to branch over a period of 12 months. Now, branch office has sold scripts in March 2023 which are exempt. So do you feel full input tax credit is available to the concerned branch office? If yes, then will it be for all the 12 months, or will it be any different position for the first 11 months and the last month in which there was an exempted transaction? And do you feel if it was something else than scripts which are exempted, will it change the position? Any thoughts from any of the
intrusion? Subramanya, just Shankar Narayanan here.
Yeah.
Even for the first question, I think the second scenario, the driver, I would think would be the deterrent to avail the input tax credit. In other words, 17.2 or 17.3 read with 42 or 43 when it kicks in, that is when the eligibility to avail the credit goes off. The eligibility of full input tax credit is what I feel. When we are talking about duty credit scrip, and now that since last year we have a clarification that it will not entitle a reversal, we would be tempted to assume that the input tax credit is fully eligible.
In the scenario 2?
Yes.
What are your thoughts on scenario 1, sir?
In respect of scenario 1, now I have another branching question. Are we going to say the petroleum products are considered as non-taxable or non-GST? The basic question which has existed for some time. If we assume that it is non-GST, again, as some other learned faculty pointed earlier, revenue is going to assume that it is non-GST at this point in time, then it would not result in a reversal, thereby making it fully eligible. Whereas if they assume that it is not taxable, then in that case, the reversal will get attracted. So it will make the situation for not being eligible for full input tax credit.
Okay. That's right, sir. Maybe without, I know that there are a few thoughts on whether petrol or lubricant is there. So what I wanted to convey here is, or what I wanted to bring out here is, in case of scenario 1 or a similar situations, so the eligibility of the credit, whether it is specific in relation to taxable activity or common in relation to both taxable and as well as exempted activity, is very clear in scenario 1. But when it comes to scenario 2, take the example of scenario 2, first 11 months, you never would have thought that there would have been an exempted activity in month 12. So for all the 11 months, it is a clear case where the full ITC is eligible. So my point here was, at the stage of availment of credit, in terms of rule 42, do we categorize this credit as a credit which is fully eligible, or do we categorize this credit as a common credit? Is the point I feel could be relevant to determine the aspect whether the full input tax credit is available or not to the recipient, is the point I see in this particular scenario, sir.
Okay, there again, so, 42.2 will take over. 42.2 expects us to do a yearly reversal.
That's right.
Even if you are doing it on the 12th month, it is still going to say that the full ITC is not eligible.
I have a different thought on this, sir. So we determine a particular credit as specific or common in the month of availment. Let us say in month 12, in the second scenario, we have considered this as a common credit. Even when we do a year-end based reversal, the position or the nature that we have given for the first 11 months to these credits will not make it common. will it still remain as specific? I feel only the turnover is what will change, and the credit, the common credit per se, once you have categorized under a respective T1, T2, T3 for the earlier periods, for the first 11 months, the 12th month credit, which is considered as common, will alone be a point of concern or a point which is to be addressed when it comes to the year-end reversal, is my view on it, sir. Maybe if anyone else has have any other view, maybe if they can come in, we can look at it and then we can go to the next slide. Or Shankar Narayan sir, if you had anything in specific against this thought of mine or anything else that you have in relation to this full ITC, you can let us know your thoughts and then we can go to the next
I stick to the same thing, saying that if you say it is common in the 12th month, the 11 months automatically takes over, meaning even if it is only for the 12th month, the proportionate reversal on a yearly basis, when it is carried out, as it may be minuscule when it is done for a year, but still it will mean that you are not entitled for the full input tax credit. I believe 42.2 is the limitation.
That's right, sir. I understood completely. I agree your answer from the perspective of Rule 42 and the interpretation of what is common for the monthly provisional reversal and what is common for the year-end reversal. But when it comes to valuation, month 1 to month 11, when I keep availing these services of marketing, I never expect that month 12 there may be certain exempted transaction. So if that is the case, if revenue were to take such a position, will this raise a question mark on the valuation that we have adopted for all the 11 months, where I even don't have a thought as to why, or I may or may not do certain transaction of exempted in month 12. This was my point, and the wordings that we see in this particular provision is in respect of the services is eligible for input tax credit. I'll just open Rule 28. So the second proviso, provided further where the recipient is eligible for full input tax credit, the value declared in the invoice shall be deemed to be open market value of the goods or services, is what they say. So will it mean that it is in relation to that particular credit which you have intending to, or that particular supply or inward supply in question, the eligibility is being looked at, or for the entity as a whole, and whether it will apply even for the period before, is my thought. So I'll just leave this question as is and continue to the next slide in case if anyone has do not have anything else to add here. Okay.
Sorry
So
to barge in. Just a reminder that you have only 5 more minutes.
Yeah. Yes. So next is on the issues or questions in Circular 199. These are not the questions raised from the participants, but few questions that I got, which I would like to, maybe after the questions are I'll put in my point, and later on it can be further deliberated and discussed. So has the circular not clarified the position when the distinct person happens to be in the same state? So right from the beginning, if you see the circular, it has only spoken about the distinct person in one state and the person in the other state, the head office and branch, which are located in different states. Has this apparently not clarified the position in relation to distinct persons located in the same state? Number one. Number two, serial number 1. See, per se, going by, the department can of course take a view that it has clarified only the position between two branches located in different states, or the head office and branch located in different state. Number one. Serial number, the second point that I have is the circular talks about third party services. So when the services are taken from third party and they are rendered in turn to the branch office, what would happen to the application of second proviso to Rule 28? Apparently, there is no reference to applicability of second proviso to Rule 28. I feel even for the services which are procured from third party and distributed are attributable to the branch office, the second proviso should still be eligible, still be applicable, though it is not expressly stated. They only say if the services are attributable to the branch office, then you can go ahead and raise the invoice under section 31. Exclusion of salary cost in cases where full ITC is not available. Is it valid? Yes, I think this is one more question that we have to further think about and deliberate, because can the provision or can the circular exclude certain portion of it? Till the circular is beneficial, I think we can take the benefit of that particular circular. However, the possibility of a challenge of a circular by the departmental, by the revenue side before the courts on this particular issue is still there, considering the judgments which we have got in relation to the nature of circulars. Next isn't the question on ISD versus cross charge concerning third party services dependent on self-assessment of ITC? So what I was trying to say here is, whether we go for ISD or cross charge is essentially dependent on how we treat the ITC, I feel. So let us say I've taken some services from a few parties, and the services clearly are also in relation to the branch office. So by claiming full input tax credit in a particular state in the head office, I go ahead to also say that the entire ITC is in the course of furtherance of my business. My business as in my GST in which the head office is registered. By saying that, I think there is automatically a inbuilt requirement to do a cross charge when it comes to those services, because in turn or else the other side of it is I have to forego the credit which is not in relation to that particular GST's business. That would be quite a natural converse of it. So if I claim the entire credit, saying that, taking a stand and self-assessing that it is my credit, then the portion of it which is attributable or relatable to the other branch office is something which I have to certainly cross charge. Alternatively, at the stage of taking the credit itself, I go for an ISD registration and take the ISD, considering myself as an office, then there is no issue. We are anyways distributing the credit based on the turnover as per the requirement. So my point was, in relation to the third party services, at least it is a very clear case of assessment of ITC, which will help us determine whether you are going under cross charge or ISD. Next is, will cross charge apply for exempt services for head office to branch? So the circular has spoken mostly about the supplies between head office to branch, but I think we should also give a thought in case if this is applicable for the exempted services between head office to branch. It could be in the instance of healthcare, or it could be in the instances of schools. If there are any transactions, will this add to the exempted turnover of the head office is one more thing that we have to consider. By opting ISD, are we obviated from cross charge? I feel no, because every transaction you have to see whether you are required to cross charge or whether there is an element of service which is from here to there. So the last slide that I would like to just take here is the few scenarios or few service examples into three categories, and leave it to your thought as to what is that which is specific or which is unique in these three categories, for us to further decide whether we should really go for cross charge or ISD, or whether there is a levy at all. So first is security services. It is a manpower based contract, mandate based contract, provided both at branch office and head office. Invoice is completely given to the head office. I intended here. Stock audit services head office and branch with a bifurcation of fees. Invoice on the HO. So these two instances is one category I see. Category 2 or a subcategory of 1 is copyright for brand, statutory audit service, ROC fees, accounting software, bank charges at HO, interest cost at HO. So these are common for the entity. Last category, the so-called, or maybe probably the internally generated services, managing director services, accounts team, HR teams cost. These are internally generated services, if I have to say. So in category 1, there is a clear demarcation. In category 2, it is taken by the entity as a whole. Category 3 is the internally generated services. Category 1 Third party services, very clearly the circular has addressed. I see no issue that these services, if full ITC is taken, it has to be further cross charged, or through ISD it has to be distributed. Category 1B, these are the services I feel, at least ROC fee, statutory audit fee, these are taken up by the head office in its capacity as head office. I feel for the supply to be supply to trigger, there is a need for the supply to happen, as in there should be consensus between the, once we call the head office and branch offices as distinct persons, there should be a requirement or a need which is arisen from the branch office for the conduct of statutory audit, for the ROC compliance. So that is not there per se. I feel it is more like a self-service, if we have to say, to the head office. So my take on this, the second category is it really satisfying the levy? I feel there are a few questions there. Third category, of course, internally generated services. Again, will it again be a case where it is a self-service, or will it be a case where you have to further charge? But considering that now the circular has clarified that if the other entity is eligible for the full input tax credit, the value will be deemed to be nil. By giving this particular proposition, I think this discussion on certain elements could purely be academic, because most of the situations are covered. However, only in a case where the ITC is not eligible to be claimed by the receiving entity, then the question of valuation would come in, where we have to see what would be the value that we have to probably adopt. So with this few questions or thoughts that I have, I would like to hand it over to Gurjit sir to give us some more thoughts on this, so that we can again discuss on the questions which are raised.
Thank you, Subramanian. Let's welcome Gurjit sir for the next half of the session.
Thank you so much. I'm just trying to share my screen and trying to locate that. Yeah, I've got the tab to share the screen. I think I'll need to be made a host, because I see it as being, as a participant, I'm not allowed to share my screen. Well, I'll start with first of all, the kind words which were said for me by Arpit Haldia ji. Very kind of you, sir, for such an introduction by me. I don't know whether I deserve that or not. And one more very important thing which I want to share here is that it may or may not be possible at the end. The kind of efforts Arupda, Venugopal sir, Uni sir, and Arpit Haldia ji is doing to arrange these sessions, the efforts they have to put in for coordinating with everyone, that they need to be commended. These need to be commended. They do put in a lot of efforts. I'm still not able to share my screen here.
So please check now, sir. So can you share
Now
screen?
it's okay. Yeah. Now it's okay. Yeah. So is my screen visible?
So maybe in a few seconds it will be visible, sir.
Yeah, there is a time lag sometimes.
Yeah.
So just let me know when it is visible.
Yeah. So now it's visible.
Okay. I need to start my camera also.
So that will be here. Yeah, that will be better, sir.
I think it's visible now, no?
Yes, sir, it's visible.
So no presentation from my side as such, but some quick points. I'll not take much time on this. First, the basic thing, what is, why the need for ISD arose, the logic for that. So very simple thing, let's say invoice received by HO, there are many a times contracts undertaken centrally. Then the services are utilized at BOs. HO cannot avail services as ITC is not used. So even Subramania sir was sharing something about, but basic concept is that if the services are not used at that location, the ITC cannot be taken. Another issue, services used by BOs, they should be taking the ITC, but then invoice is not being received by the BOs. So they again will not be able to satisfy the conditions for availing the ITC. So to cater to these situations, the mechanism of ISD came into existence right from service tax. And here, for general understanding, we do talk it about as an HO and as BOs or among us BOs. While we are thinking or discussing this, we should consider it as different units, may not necessarily be only from HOs to BOs or vice versa. So ISD, as per the definition 261, is applicable to office of a supplier. So ISD needs to be an office of a supplier. Many a times there are some administrative offices who themselves are not supplier. And the purpose is distributing the credited to a supplier of taxable goods or services. So the credit needs to be distributed to a supplier of goods or services. Here again, I'd like to just highlight this, that section 20, when it says it is to be distributed, credit is to be distributed to registered persons. If we go to rules, it says may be registered or unregistered. But if we come to the definition of ISD and we focus on this thing, that the credit is to be distributed to those units who are suppliers of taxable goods. So these suppliers, if we assume that one of that units is a supplier, but that is a totally exempted supplies, that particular unit. So that means that unit may not need to be registered due to section 23. Is the credit to be distributed? Yes, credit is to be distributed if it is through the ISD and the ITC was availed by this. Another thing which another important thing about ISD is that though ISD registration is obtained as a separate registration for a normal taxpayer, that is for their outward supplies, the ISD on their own, they will not be having any outward supplies. It becomes a registered person by the definition of a registered person by going through the process of getting registration. This was raised by our colleague Yogesh Arjai also in the last meeting when the circular was discussed. It was said by Yogesh ji that ISD becomes a registered person, but it should be kept in mind that ISD does not become a registered person or a recipient as if he is the person liable to pay the tax for the purpose of payment of RCM. So we have to distinguish between that. When we consider ISD as a registered person, is it for all scenarios? Say, for example, for RCM, it is not there. The rule, sub-rule 1 capital A of rule 54 was introduced just for this, that the unit or the HO can raise an invoice to the ISD at the HO for the RCM, because ISD cannot pay RCM on their own. So it has to be paid by some, let us say, HO. And if it is applicable at that location, and then they can raise an invoice to the same PAN registered ISD for RCM. Another thing, now move on, if we talk about some other aspect, ISD is for distribution of ITC of services. And we tend to think of cross charge also like that. But is cross charge really for distribution of ITC of services? Circular also is saying, while clarifying the first point, that yeah, ITC can be distributed through cross charge, but we must keep in mind that as per the press release, the ISD mechanism is going to be mandatory, and it is going to be mandatory prospectively. That is also said in the press release. So our future planning should be in terms of this, that ISD is going to be mandatory. Till that point of time, the circular helps out in a lot of ways. cross charge, in fact, if we think in terms, so ISD is for distribution of services, IT for distribution of ITC of services. Cross charge is not exactly for distribution. It is for supplies made to distinct persons. Cross charge comes into existence because it is said that supplies are made, Schedule 1 comes into play, and those supplies have to be charged. The result may be that transfer or distribution of ITC happens. And this transfer or distribution of ITC may involve the ITC of goods, which may include capital goods as well as services. The HO may be having a lot of servers there. The capital cost is huge. By cross-charging, because they have to do it cross-charge due to Schedule 1, then that ITC also gets distributed. That is a result of the cross-charging. Cross-charging can also result in avoiding accumulation of unutilized credit at different locations, especially if those locations or those units, they do not have outward supplies. But all this has to be within the parameters of the entire scheme of the things, whether there are any services rendered by those outward locations or not. ISD services are provided by third party. Does the law specifically say anything like this? Few minutes ago also we were discussing whether can this be done. The circular 199, while answering the first part about services procured from third party, says cross charge can also be done. Circular very clearly classifies the clarifications into two parts: services by third parties and internally generated services. So we have to look into things like this only. Can one unit raise an invoice to the ISD for the services rendered? May not be very clear from the legal provisions, but the specific introduction of, again, that sub-rule 1 capital A for the RCM services, just for that specific services, that was the intention mentioned when that rule was introduced. But that it be extended to all other situations also? That leaves a gray area. Cross charge, so it is for services provided by third party, and generously circular says that even for third party services, cross charge may be used. But otherwise, cross charge is for services provided by or transferred by one unit to another unit. So about goods also, I've mentioned goods, but mentioned that in a very light color because goods physically flow. For that, it is not very difficult to do the cross charge or charge values, etc. It is the services part. There is a school of thought which also says that Schedule 1, the entry 2 should not include services. That will ease a lot of things, but I don't think that is going to happen. What if somebody is not having an ISD? No consequences except loss of credit. So that credit may be huge, but it needs to be compared with the cost of compliance for ISD registration. That is another thought, till the time the ISD registration becomes mandatory. Now we come to this part. Is cross-charge an option? Specifically, we are bound by entry 2 of Schedule 1, particularly supply of services. We are again ignoring goods here because that is very simple, even if made without consideration. So supply of services between distinct persons, they could be specific supplies, or here where we come to internal generated services, there have been queries that should we define internal generated services? If I make an attempt to define this, it could be activities of a distinct person which benefit the other distinct person, or which are use of or useful to or used by other distinct persons. So these become internal generated services for which the invoices should be raised by that unit which is providing the services to the other distinct person. Now, is it mandatory? We raised a query, is it an option? So is it mandatory from the taxpayer's perspective? So there the query comes of the levy. There is a positive confirmation which is required. Is a supply established? Section 7 says that activities mentioned in Schedule 1 will be supplies. Schedule 1 is also headed like that. But there are certain ingredients of Schedule 1. There are some things that, like say, transfer of assets. That is an activity. But when we come to the entry number 2, it specifically says supplies of services between the distinct persons of goods or services. Is it really a supply? Has it been made or agreed to be made? Is it an act which is positively done? Is management stewardship itself a service? In the previous discussions on the 199 which were there, when Yogesh ji was raising the query in terms of circular 199, that can HO raise invoice for services procured from a third party? Can it be said that HO has rendered a service? And one of the faculty members had entered that whatever HO does for the units or other units, that is a service that has to be done. So that is one view. The other view is that management stewardship is not a service. It is not agreed to be made. That is what management is about. That is what HO is for. That is what HO is for. Then next part, is valuation possible? We come to the charging mechanism, Rule 28 to Rule 31, open market supply for services done by HO or internal generated services. That is not possible. Like value of like services, that may again be a challenge. Then we come to the other parts, some other things. Also, entire value chain of Rule 30, we can say, it says cost plus 10%. So can the cost be attributed? Here, as chartered accountants or practicing chartered accountants, we must think also about that many of the larger companies, they designate their different units as cost centers, maybe for allocating the cost or maybe for performance testing, etc. So those accounting principles for those cost centers or performance evaluation, etc. Those principles are there, but can it be said that those are the services? But if we consider that cross charge is mandatory, those things will get involved. Lastly, I'll come to Circular 199. It has clarified many things. We are now aware of that point number 1, 2, 3. But what is its implication? What it says, the implication is that in respect of internally generated services provided by HO to BOs, in case where full input tax credit is not available to the concerned BOs, computing the taxable value is mandatorily required. It does not say it is mandatorily required. It says that where full input tax credit is available, it is not required. But it implies that where full input tax credit is not available, it is mandatory. That is what revenue is going to talk about. Revenue is going to focus on this part, that wherever full input tax credit is not available, then it becomes mandatorily required. But the relief is that cost of salary of employees of the HO may not be included in the taxable value of such supplies. So there is a lot of discussion that full input tax credit, what is it about? Like Subramanian sir also said, full input tax credit is not a term introduced by this circular. Though circular, it would have been much better if circular would have clarified this term. Full input tax credit is part of the Rule 28, the second proviso, which says that if full input tax credit is available. So that flows from the rules itself. Circular does just a mention of that. So just going to the circular, highlighting some of the things. So procured from a third party, that is the first part. And here the option is that either ISD or cross charge. But ISD prospectively is going to become mandatory. So cross charge will not be an option for services procured from a third party. So can HO raise till that time the ISD becomes mandatory for services procured from that? So that was a question raised in an earlier meeting. So this circular says in itself that in respect of any input services procured by HA from a third party for and on behalf of HO. So for and on behalf of HO, for and on behalf of a BO, if HO procures that services, I think HO can raise the invoices. It is not that the services have actually been rendered, like we were saying, the security services or maybe any other particular defined services where they are separately identifiable. It is not necessary that HO renders those security services. HO has received an invoice and that services to the BO are procured by HO for and on behalf of a BO. So that's the definition of agent and the deemed recipient in section 16(2)(b). Those definitions come into play. So into my mind, within the circular, it is clarified that since HO is procuring those for and on behalf of BO, they are. Second point is about internal generated services. This I have already mentioned, that it is the second proviso which says the eligible for input tax credit, and it has not been defined. And if we come to internally generated services, where the other is, it says it is not mandatorily required to be computed. That point I have also highlighted. So I'm just stopping to share my screen. We can now come to the questions which are there. I think a lot of time we have taken for that, other discussions. So I think Subramaniam ji, if you were going to start taking those questions which were shared earlier with
I share my screen, sir.
Yeah. Or I can share the questions and
You can share it, sir.
yeah, I think the screen sharing would be visible. So these were the questions. After we go through these questions, then we will come to the other questions, if any of the participants may have. Is that right? I'm asking the host and the coordinator.
Yes,
Yes, yes, sir.
we'll take up
Yes,
these
sir.
questions first.
So I think you have come out of the screen share mode, sir. Can you share
I've
it?
come out of that. Okay, I'll do this again. Is it visible now?
Yes, sir. Yes, sir. So I'd like to just read and give my point in relation to first few questions. And if anyone has anything, Gurjit sir or anyone has anything to add, please do it. How do we define internal generated services and valuation thereof? I think there is no need for us to go behind the definition of internally generated services. It is more about the services which were sought by the branch office, or for that matter the other GST number or the distinct person, and which are rendered by the head office to them, is what is relevant. And when it comes to the valuation, yes, the question of valuation where full ITC is available is only academic. So the real need for getting into the valuation will arise only when the recipient entity is not eligible for full input tax credit. Now, if we concede that services 1, 2, 3, which apparently are services from the HO to the branch office, or one GST number to another GST number with the same PAN, then I think the valuation will be determined as per Rule 28, since the second proviso will not apply, and there may not be open market value per se, and the similar value. So we have to end up at the cost based valuation. And once we go to the cost based valuation, I think we can go ahead with the relaxation which is provided to exclude the cost of salary of the head office, and the balance can be looked at in terms of the attribution. But however, when it comes to various other costs, it could still be a challenge for running the head office. There could be the cost of interest which is taken at the head office, or it could be other non-direct costs. Whether those costs should be included or not will be a point of litigation probably between the department and the SSC. But to my mind, we have to really see whether the services which are intended from the head office to branch are really sought, or is it a self-service? Are we trying to do a cross charge? So as I mentioned about 3 categories of services in my previous presentation, so leaving apart the third party services, if we go to the last category where we spoke, where we listed a few instances of internal generated services, I don't, until and unless there is a need for the ingredients of levy attracting, though the consideration is not the essential element, if the other ingredients of the supply are attracting, then only the question of valuation would arise. So on that, and the next point is on the ESOP registration reimbursement. Is it
Subramaniam sir,
yes, sir.
can
Please.
I just, for the first question, I'll just like to, the internal generated services, I've attempted a definition earlier. So that is one part. About the valuation, the query, it says that accounting services from HO or another such services, it leads to salary cost of employees. So is it required? And the query says which is not required to be considered. It is not that it is not required to be considered. Circular clarifies that even if it is not considered, there is no action going to be taken for that. Even the recipient of such internally generated services may not be able to avail the full ITC. So even if the salary cost is included, that is at the option of the HO or the service provider who is raising that invoice. That is, it is not that salary cost has to be excluded. It is not mandatory to include that salary cost. In one of the earlier GST Council meetings, I think it was the 35th Council meeting, when a draft of circular of ISD was made, which was not ultimately issued. The current circular issued is much more beneficial than that draft circular. But in that draft circular, it was said, one of the clarifications was that no new documentation or record keeping, etc., should be done. Whatever the in normal course of business these units are keeping, so that should be taken as a base. So for those units where we, like I just mentioned, where the cost centers or some performance evaluation, some costs are being allocated, like in the Cummins AAAR of Maharashtra, the Cummins said that they are allocating costs. So there that allocation of costs come into play. Otherwise, it will lead to the valuation challenges unless and until some taxpayer is brave enough to challenge that the levy itself on the points which I mentioned.
Yes.
Yes, Subramaniam ji, we can go on to our next one.
Second question, whether the ESOP reimbursement is cross-chargeable. I believe is the question related to the ESOP reimbursement involving entity outside India. I wanted a little more thought if that was in relation to the thing outside India. Maybe.
So the thing is, outside India, the entity shares will be granted to the staff of multiple units across India, and the central office would be reimbursing for it. But these specific persons would be in multiple states, so there could be a requirement to allocate the corresponding cost to whichever vertical handles those employees.
That's right. So basically, the cost which is borne towards this ESOP by the head office, if you have to say, relatable to the branches.
Yes.
Again, by end of the day, I think even by the income tax provisions, it is part of the salary, I believe, when it comes to the transaction between the employer and employee. So if this were to be considered as the cost towards the salary, which is the apportionment of salary between branches is of course an internal arrangement, but by end of the day, the value of service which is paid for is towards the salary cost, I believe. And I think the benefit of the circular could still be considered, is my view on this. Anything from your side, sir? Gurjit, sir?
I'll agree that Schedule 3, which says that services by employee to employer, a wider definition should be there. And that is generally accepted, like it has been accepted, almost accepted rather, for say, when somebody is resigning and they have to pay the employee, if they don't serve notice period, they have to pay certain amounts. So those are not now being considered as a service provided. So that is almost decided. So in terms of that wider definition, such reimbursements should not be very challenging, that it must be included in the cross-charging cost. I'll agree with what
Yes.
Subramaniam said.
So whether circular is going beyond Schedule 1, I think see, if we read section 168, it is to ensure the uniformity in treatment adopted by the field formations is the indication that comes out from section 168. By end of the day, if the provision is saying something and if the circular maybe gives more relaxation to say that in the context of this 199 in third party services, they say even if the invoice is not raised, it will be deemed as raised for nil. And in the context of the third question, if they say the cost of salary need not be added, I think it is a stance that the CBIC has taken or the board has taken not to issue a notice for these kind of issues. Per se, I don't see any challenge or any issue when they relax something, because we have many other instances where they agree the position of rate of tax on as is basis. So is this allowed under the law? Is it going beyond? So it is only indicating the thoughts of the department or the on an overall consideration. It is trying to take into situation the manpower and other things that could go behind these particular issues, and they just want to say that they don't want to get into this. That's the reason they have defined it as nil or deemed to have been issued at nil, or they don't want to get into the salary cost. So I don't see that, yes, there is some relaxation. What is not there in the valuation rules is being brought in here to say that, but I think it is not changing the valuation rule per se, since it is only for the field formations. It is only clarifying that they would not issue a notice for these kind of issues. So to that extent, in my view, I don't think the circular is going beyond Schedule 1. It is only saying the field formations not to challenge the proceedings or not to challenge the valuation in case if there is a deviation of these provisions by this circular. Any thoughts, sir?
No, I'll just like to add that the circular has been generous that for the earlier periods where full ITC is available, circular says that even if it has not been, the cross-charge invoices have not been raised for internally generated services, the value of such services will be taken as nil. So like, I'll agree with what you are saying, that they have agreed that they are not going to take any actions on that. But in future, then it will, circular is there till that time. Yeah, it is there. It is beneficial to the taxpayers. So no challenge is expected on that part. Department is not going to take actions on that.
Yeah. Whether the same can be extended to related person, as both are placed similarly in Schedule 1. I think the context of issues that could come intersay between the distinct persons and related persons could be different, I feel. Because here we are talking about two situations: third party related services and internally generated services, which are in a way implicit to the transactions between the between the distinct persons. But take an example of a holding company and a subsidiary company. For the in case if you have to take an example of a related person, so the transaction or the terms or the deliverables or the activities will be clearly demarcated as to what is that one of the related party requires it from the other related party. Though consideration is not a requirement for us to test the levy, but the consensus of the parties being two independent parties, not just by deeming fiction but also by their legal existence, will make the transaction even more clear that there is a levy between these two entities. But coming to the valuation, yes, I think the valuation is, the circular has given benefit only to the extent of transaction between distinct persons, where they say it will be deemed as nil even if the ITC is not, it will be deemed as nil even in a case where it is not raised or the cost of salary need not be excluded. I think this particular relaxation, these two relaxations are limited only to the extent of distinct person transaction and not covering the related party transaction. Of course, the general provisions of Rule 28 will come into picture to determine the value between the related party transaction, with the caution that there is a clear case of supply in between the related party transaction as against the distinct person transaction, where it is not very clear. Anything to add, sir?
My view would be that as far as the second proviso of Rule 28 is concerned regarding full ITC available to the, in case of related persons, the circular has expressed the views of the department, though not specifically stated that it is for related persons. It can be that confirmation can be taken that it is confirming that for related persons also, but only to that extent the applicability of that. Otherwise, it can be extended to related persons. Otherwise, not of course in the other situations, the salary cost of employees, etc. That will be a strict no-no. That has to be included in the cost, whatever the costs are there, or the open market value or whatever are there. But as far as the second proviso to Rule 28, yes, it can be taken.
Can we slide? Yeah. What is the use of Rule 32.7? So in fact, this was actually this question made me read Rule 32.7, which I missed it. So Rule 32.7, I'll just extract it for the benefit of everyone, where it actually provides a mechanism where
I'll share the screen here. So
Yes,
for
sir.
you to share the Rule 32.7. So yeah, I think it's visible.
Send it in the chat as well. So I'll just read it out.
Okay.
Yeah, Rule 32.7, the value of taxable services provided by such class of service providers as may be notified by the government on recommendation of the council as referred to in paragraph 2 of schedule 1 of the act between distinct persons, between distinct persons as referred in section 25, where input tax credit is available shall be deemed to be nil. So the what is expected or what is actually given in the circular is something which the government could have exercised its power by way of issue of a notification, where it could have issued a notification notifying a class of service providers who would not be for whom the value for the distinct person transaction could be considered as nil if the receiving entity or the receiving distinct person had a full input tax credit of it. So whatever is expected to be done out of Rule 32.7 is already available as a benefit by way of this particular circular. Again, the same point, the government could have notified and could have said this, but alternatively they have taken an easier route to give a larger benefit, that they would not proceed, the field formations would not proceed for action against these transactions because they have already relaxed the requirement. So to that extent, yes, what could have been achieved by notification is already given as a benefit indirectly through the circular.
Yeah, I'd like to add here that notification may have a little more backing, legal backing than a circular. So considering that, but the other option, like Subramaniam sir has just said, that the circular gives a wider implication because the notification could have a restricted to certain kind or class of services. But one distinguishing point I'd like to raise here is that the second proviso to Rule 2 talks about the full input tax credit. Whereas this particular rule just says where ITC is available. It does not talk about the full credit. So that is one distinguishing part. But in their wisdom, instead of going by way of issuing a notification, they have clarified through a circular, and that will be more beneficial to the taxpayers, except the situation where that culling out the meaning of full tax credit will come into play.
Would you take over the next question, sir?
So whether Circular 199 can extend to goods. Goods are otherwise physically movable, identifiable. So yes, goods. The circular does not talk about or I should say that it does talk about services because goods are physically transferable, they are identifiable, and their valuation, costing, etc., is also not that challenging as much as services. Is there a need for extending this to goods? That will be my query. In earlier regime, in excise, etc., the cost allocation for excise in certain cases that used to be challenging, and all the salary costs, etc., whether they are to be applicable, because within one company there could be multiple excise registrations for each separate manufacturing unit. But currently in GST, I don't think there is much requirement for that, or maybe the person who has raised the query, they can add something. Subramaniam ji, if you have to.
Nothing else to add, sir. Nothing else to add.
What is the next question is, what is the impact if services rendered to distinct person was billed through ISD? Yeah, so this brings us to that query again, which was raised earlier, and it takes us to the uh, query later, which is about the GSW Orissa judgment also, but specifically to this. Can the services rendered to distinct person be billed through ISD? The circular has very clearly segregated into two parts, the third party services and the internally generated services. And for internally generated services, the ISD route has not been shown in the circular. And I'll tend to agree towards this view that for internal generated services, the ISD mechanism may not be applicable. I have already referred to that sub rule 1 capital A, but that was introduced basically for the RCN because ISD cannot generate that RCN. But can it be extended, because the intent is not mentioned when rule is notified, when rule is inserted. The intention is it was there, but now since it is there in the rules, so can it be extended to serve? That extension by implication could be a little challenging, but I think rather than ISD, it should be the cross charge or the internally generated services method would be more or less controversial. Less controversial. I was trying to say more beneficial, but I chose less controversial. Yes, Subramaniam ji.
Yes, I think the question is basically, will the invoice from one of the distinct persons to the ISD, will it still be considered as a third party service? For the want of the circular is one thing. I think it really depends on the nature of service. If it is a clear case where it is a service which can be done in that way, I think I don't see any issue. But ideally, than through ISD, if it is a clear case of service that could have been built to other distinct entities, it would be a much better method of dealing with it. By end of the day, if the question will be academically in case if the entity is receiving the input tax credit and there is no issue on the valuation. Yeah.
Following your thoughts, Subramaniam ji, I'd like to add that distinct persons, yes, they are distinct persons. Legal entity may be the corporate identity. If we take that identity, that may be common for all the distinct persons. But since for GST purposes, they are distinct persons, it is a deeming fiction created. And by that deeming fiction, there is another deeming fiction where the supplies between distinct persons are deemed to be supplies taxable for GST. But whether they are really services rendered, that is the query which needs to be answered in this person. Can that deeming fiction be extended to this part also? That distinct person is actually rendering services. There could be some instances where one unit is actually rendering some services, but broadly that considered, so that would be a challenge there. But by implications, and if we try to have a simpler understanding, I'll rather suggest that the distinct person should not follow the route of raising the invoices to the ISD. Next query is, can the HO actually raise invoice for a service not rendered by it, for example, life insurance premium paid for employees of branch? I think while discussing the circular, I answered that there could be services which are procured by HO for and on behalf of the BOs. So actual rendering of a service may not be the prerequisite to raise an invoice. They have procured those services and they are billing that. That may be as definition of an agent or the 16(2)(a. Is it a pure agent? In Cummins AAAR, it was said that it is a supply of services, but valuation need not be attached because that is done as per a pure service, pure agent. But I don't think all the ingredients of a pure agent are satisfied. The HO can, in my view, raise invoices for services which are procured from third party on behalf of it.
Yes, sir.
So should we move on to the next query?
Yes, yes, yes.
Last one here, which was shared with us, that valuation of cross charge plus the 28 Rule 28 proviso can be used to play around with maximizing credit utilization, ensuring reversals under 42 unit and 1 or lower, minimum cash payment in relation to JSW Steel. Where do we draw the line? And it was also said that if there is one BO, it sends an email asking HO for an opinion. HO gives a management consultancy. Can it say raise a imagined amount of 100 crores and take refuge of Rule 28? So cross-charge valuation is a challenge. That is first thing. So can the second proviso 228 or otherwise when cross-charge invoices are raised, that is, can it be used to play around? In the query, there is a reference to JSW Steel case also. I'll briefly refer to what was the JSW Steel case. There were some mines in Odisha. JSW Steel tendered for that. They were awarded the tender and mines were in Odisha. There was JSW Steel Odisha distinct person formed and they started the mining operations. The iron ore, etc., or the minerals which were taken out from that mines, they were outward supplies were made. Some of those outward supplies of those ores were to other JSW units for which invoicing was done. So there we talk about that, the goods part, that can this circular be extended to goods? Goods are physically moving, the valuation is there, open market value or the like value for like goods that is also available, or the cost plus ratio, whatever is that. So that was being made to others, that was it. But since there was a large volume of RCM cost in manner of royalties and other fee, etc., that was borne by the JSW Odisha unit, large unutilized ITC was lying there. So what JSW Odisha did, in Odisha for JSW, there was no ISD. The ISD registration for JSW was in Mumbai, that is Maharashtra, state of Maharashtra. So Odisha JSW Steel raised an invoice on that ISD for JSW Maharashtra and billed it for almost the entire ITC was utilized. And the revenue did not agree to that. They said the one thing that Rule 1, the sub-rule 1 capital A, it says that when an invoice is raised to an ISD, that should be for the same state code. It cannot be to a different state code. So the invoice raising to the ISD in the shelter of sub-rule 1 capital A, that is limited only to the same state. That was one. The other was that the Odisha JSW is not rendering any services to the Maharashtra JSW, especially in terms of the volume or the amounts which they had mentioned. And it was not specified what kind of services. It was just billed as facilitation services. So that was challenged initially 73, then later on they invoked 74. An assessment order was made. The JSW Odisha filed a writ in the court and they fought for an interim order which was denied. No stay was granted. Later on in the later on hearing, they withdrew their challenge and they said they will resort to the statutory options, that is going for an appeal, etc. They will resort to that. So that is the case highlighting. So both situations. Now this also leads to one more question, that can a legal entity have more than one ISD? So we have different views on that also. Some of the material, even from the articles uploaded by the indirect tax committee, there is a view that it may not be possible. There are counter views that yes, there can be multiple ISDs also at each state or more than one state. It may not be required at each state to transfer that. So that is one challenge. For raising within the same PAN an invoice to an ISD of another state as an invoice itself, it is not possible in that sub rule 1 capital A. But are the services rendered and what was the value? There this query lies. So if we go through the valuation specifications, it says that value has to be determined in terms of rule 28 to rule 31. And it is in rule 31 where we come to this term that it should be reasonable, etc. Those terms are used. So when it is not reasonable, though the provision says that where full ITC is available, the invoice value would be the open market value. So there may not be need to resort to that. But if it is read holistically in its entirety, if reasonableness is not there, it can be the transactions can be considered a sham, like the Honorable High Court did in this case. It will eventually go to Supreme Court. For that interim stay denial, there was a petition filed in the Supreme Court. I think it is pending, if I the status correctly, if I know. I'm not very sure, but I assume that it is still pending there. But that would be a challenge there. But yes, it does involve certain play within reasonableness. There's certain play of that evaluation and transferring of that, but that has to be done. And there again, our normal accounting principles or standards would come, would have to be considered, not beyond that. I think I've taken a lot of very longish answer to this one. So Subramaniam sir, your views on this?
Yes, sir. I think as you rightly said, JSW, by end of the day, it was not a final order. It was an interim order where some observation was there. And finally, the petition was withdrawn. But rightly, the issue that was being addressed there was that very fact that there are two contexts which are there. There is also a mention that there was an excess credit which was lying. And they also say that this is in relation to the services, the support services or business services which they have rendered from here to there, from Orissa to other states through the ISD. It was built to ISD and from there again distributed. So I think rightly the observation was in relation to that particular context. The very reason for the invoice appeared to be the reason of the unutilized credit which was there. And coming to whether the second proviso's benefit can be taken to accommodate this kind of a transaction, if you see the placing of the section and how it is there, it is more of a situation where the department do not want to get into the litigation or the ambiguities or the interpretations when it comes to the valuation between the distinct persons or the related persons. But since that being the possible interpretation, using this rule to pass the credit unduly, of course, I think the transaction could be considered as sham as observed in the interim order by the Orissa High Court. That's all, sir. I think those are a couple of points I have.
So I'm going to stop sharing my screen, and I think we are handing over to the coordinators for other queries, etc. Is that the right way to go, sir?
Yes, sir. We have some queries in the chat box, so requesting you to kindly go through those queries and give your views on the same.
Yeah, I'll read it, sir.
Yeah, please.
Sumit Agarwal ji, can we argue that services received from third parties at head office is for internal consumption of employees for employees providing services to branches, and hence there is services by employees and hence not taxable in terms of Schedule 3? I think, Gurjit sir, do you want to take it? Can you please take it? Shall I read it again, sir?
No, yeah, I'm going to read it. I'll try to make an attempt to answer that. So the query is that can it be argued that services received from third parties is for internal consumption of employee for employees providing services? So there could be some particular services, but can it be extended to Schedule 3 that it is a service by the employees and hence not taxable? I don't think so. Services procured from third parties, if we are just referring, like say something like life insurance, etc., or some what particular kind of services, it will depend on kind of services also. Um, can it be considered that it is Schedule 3? I don't think so. I don't get that idea. To the extent I have tried to understand the query. If we have to say anything, Subramanianji?
Maybe if we take the example of any services which are used in the execution of the duties at HO by the employees, will that be requiring a cross charge? If that were to be the question, I think Schedule 3 may not have a say here, because Schedule 3 is for the transaction from employee to the employer, but the issue here is for the transaction between the distinct persons. So I think the basic question that remains is it a self-service, or was it intended to be received by the receiving or the proposedly receiving distinct entity will be the question that will be there, which will probably answer the question. I think where there is a definition or demarcation as to the defined services, these are the component which is allocable to head office and allocable to branch. I think that instance alone may call for cross charge, I feel. Otherwise, not all internal generated, as Gurjit sir also mentioned, the very intent or the purpose of head office is to carry out the functions, even as per the income tax provisions, or it could be the ROC records. Even for the GST records, the head office has to maintain certain records and have certain things in place. So, which means that it is implicit a duty for them to have the accounts records, have the people managing it in that particular place. So it is more like a duty that is cast on the head office rather than a service which is rendered by the head office or the one of the entities to its other distinct entity. So going by that logic, I think not every internally generated service should call for a cross charge.
There was a next query. It is by Oni sir. It says if you can count the server, why not some proportion of the general infrastructure? I think Oni, or is it by Jigar
It was an answer to an earlier question. So requesting you to kindly move up. The question has been asked by Jigar.
Can I elaborate my question?
So I'll start from the beginning. Maybe Subramanianji missed that the earlier queries that if marketing, it is from Arpit Janji, if marketing offices across different states in India procure orders from customer and send to factory and bases the sales order, the factory dispatches the goods. Factory procures some various inputs and input services, some of which are blocked under 17.5 like rent a cab, food, etc. In such a scenario, how the valuation needs to be done for the services provided by marketing offices to the factory. So this is again a place, the situation is where the full input tax credit is not available, and we have been grappling with that query, that question, the inherent question that how the valuations have to be arrived at. So my view would be that the normal accounting principles, if those can be assigned and ascertained, like one of the participants has entered in the chat box that like in the earlier regime, there used to be cash more. We used to talk about that for allocating or otherwise, whatever is standard accounting principles, and generally allocation of that services, not extending to reap undesired or undesirable benefits, but otherwise that is how that valuation has to be done. But like I said, that the counterpoint is also this, is this valuation mechanism workable? Because if those what is the tax, to whom it is to be charged, and how much is the tax, where the rate and valuation, if these pillars are not addressed, the levy fails. So that is somebody may challenge those on those terms. But otherwise, if you don't want to go into litigation, anything which is apparently workable and which is demonstrable to the officers when a query is raised, how the valuation is arrived at, that needs to be done. One more thing I'd like to add here, though not specifically related to this query. When we were talking about ISD and cross charge, till the time the ISD does not become mandatory for prospectively, there one thing is that the ISD mechanism, the credit is distributed on the basis of the turnover. So that may not be an ideal mechanism to distribute the ITC for a business in terms of the services rendered to other units. So there the cross charge may be, in some other accounting terms, may be more beneficial for the unit. So since the circular says that either the ISD method or the cross charge method can be used, so that distinction we have to consider. That if we use the ISD mechanism, the credit distribution to different units will go on the basis of their turnover. If we use the cross charge method, we can skip the turnover of each different unit and we can allocate it on a different method. That may be beneficial in certain situations. Anything you have to add?
Agreed. For the valuation of cost plus 10%.
Yeah,
I'll just take the next question.
Yeah.
For the valuation of cost plus 10%, the CAS 4 under central excise would be used for arriving the same. I think cost, since it is not per se defined, it only says it cannot be lower than cost. The value of supply cannot be lower than cost. It is really into the point as to what is the cost, whether it will include the direct and indirect cost is something which could be an issue that could be raised. Well, even the general cost, interest cost, the other running cost, will it also be part of it, is something that can be a question which could be raised. But maybe what are your thoughts on this, sir? Gurjit, sir?
Yeah, that form was for an earlier regime, but that gives an idea to us that how the valuation, etc., is to be done. We cannot just strictly adhere to that form, but it gives an idea. It provides a mechanism that it is there. It may not cover everything. We can go beyond that, but I think sufficient has been said by me on that part, that how the valuation has to be done. Lastly, which I can see is from Oniji. It is very interesting always that I just mentioned that Rule 32(7) omits full ITC. It just says the ITC. So he has caught on to that, why it is not referring to full ITC. So Uni sir, one thing is to understand the logic. Another thing, a simple answer is that it is the wisdom of legislature. In their wisdom, the legislature has not added that. So I'll take a simpler option here now, if that is permitted. To the coordinators, please.
Yes,
Is
sir.
there anything? Yeah, please.
So I think we don't have any further questions, and so yeah, so no further questions. So thanks to both of you, sir, for taking out your time, and it was indeed a pleasure to have both of you here. Gurjit sir, because we wanted you to have as a speaker for a long time, because we wanted to take advantage of your in-depth knowledge that you have been sharing to the officers also. And Subbuji also, we have heard him, and I have heard him in the earlier sessions in KCA. And so I think that was also a wonderful pleasure. And thanks to all our faculties also for sharing the questions, because that also helped us a lot to go through the detailed discussion. Because some of the issues like Rule 32(7) or about JSW Steel, how to take about the decision, I think that will help us to frame up the decision making in the days to come. So that has also helped. So let us look forward to the future sessions, and thanks to all the participants also for joining in, because only once you join, it encourages the speakers, to give in their time, whatever the time, because it takes a lot of time and effort to prepare for a session. As faculties, you all know that. So thanks to all of you, and thanks to my co-admins, Venuji, Unniji, and Arpiji for the kind of support that we constantly have here. So thanks very much, and looking forward to all of you on 12th August. We are planning something for 12th August. Let's see once it is finalized, then maybe we'll let you know. Thank you very much.
Thank you.
Thank you, sir.
Thanks everyone.
Thank you, Subbuji.
so
Thank you.
much. Thanks for the
Thank you.
I'll only last give my thought, just in addition to Arupda, what you were saying, that the revenue perspective, revenue will focus on those situations where full ITC is not available. There the valuation, because for revenue, that is the crux. Where the full ITC is available, that tends to be revenue neutral. The जिसको हम यहाँ नॉर्थ में बोलते हैं ना, मक्खन मलाई उसी में ही है रेवेन्यू के पास. So revenues focus will be on that only, where full ITC is not available, how that valuation is done and how much will remain in their kitty. Thank you. Thanks everyone.
Thank you, sir.
Thank you, sir. Thank you for adding that. Thank you, everyone. We'll close the session for today.